Okay, students, in today's lecture and until through next week, we are going to learn about the company's payout policy, which will be the last topic to be covered in this course. Okay, so let me share the PowerPoint slide. Okay, so in this lecture, we are going to start the Chapter 17 PowerPoint slide, right, the payout policy of the company. So before we begin, let me once again show you this diagram that I had shown you already multiple times, which summarizes how capital fluctuates surrounding a company. So as we have learned, and as we have spent quite a bit of time, first of all, the company will raise capital from external capital market or external financial markets, either debt capital or equity capital, and use that capital to make investment decisions, to invest in valuable, hopefully positive NPV projects, and then the company will harvest the profits from those investments. And then lastly, the company will decide how much to retain within the company and how much will be paid out to investors as a compensation for their capital provision. So what we are going to learn in this chapter, chapter 17, is about this last arrow of the diagram, which is closing our loop. Okay, so we are going to learn about how the company pays out cash to its investors. Before we get started, let's take an example of Microsoft to get motivated why it is important to understand a firm's payout policy. So for many, many years, Microsoft Corporation has been one of the very famous non-cash dividend paying companies. Instead, for many long years, Microsoft Corporation chose to distribute cash to its shareholders, its investors, primarily by repurchasing its own stocks. But the company had not paid any cash dividend directly to its shareholders until year 2003. Well, looks like it's become quite a bit of pattern of a lot of tech giants that not paying any cash dividend. So these days, among the famous non-cash dividend paying tech giants, we can see Facebook and Amazon and Google as well. Well, Apple decided to pay its cash dividend for the first time in a couple of years ago, about 5 years ago. But as we can see, there are many tech giants, and also there are many profitable and large established firms that do not pay any cash dividend at all. Anyway, that was the case for Microsoft until year 2003. And in year 2003, Microsoft all of a sudden began paying cash dividends to its shareholders with a star dividend of 8 cents per share. That was 8 cents per quarter. Okay? Well, that was not the end. Then on July 20th, 2004, Microsoft stunned the financial market by announcing plans to pay the largest single cash dividend payment in history, which was a one-time cash dividend of $32 billion to all shareholders of record as of November 17, 2004. That amount, $32 billion in gross, that translates into about $3 per share to all existing shareholders of record on November 17th. In addition, the company announced plans to repurchase its shares using up to $30 billion over the next 4 years. And also the company announced that it will maintain its regular quarterly dividends of 8 cents per quarter, which amounts to annual rate of 32 cents per year. So that's a pretty drastic change in terms of its payout policy. From non-cash dividend at all, the company all of a sudden started its cash dividend, and then the next year the company announced a big time, huge one-time cash dividend, and also it announced the big time stock repurchase program, and also it continued its regular quarterly dividend. So what were the considerations that led financial managers and Microsoft to make such changes? That's something that we want to understand in this chapter. More importantly, we want to answer the questions about what are the implications of such actions for shareholders and the implications on the value of the firm. So if you are a current or potential investor, shareholder of Microsoft, would you welcome such changes in payout policy or no? So as an investor, to make wise and informed decision, you should have ability to interpret and evaluate the firm's such changes in payout policy. If those changes are desirable, then you should keep the Microsoft stock or consider buying Microsoft stock. But if those changes are against your personal wealth, then you should be selling Microsoft stock or do not buy Microsoft stock. So as a shareholder, you should have an ability to evaluate and interpret those payout policy changes made by firms. So in this chapter, our goal is to answer this question, okay, and obtain those such ability. All right, so before we jump into the details of the relationship between the firm's payout policy changes and its firm value and investor preferences, in today's lecture, let me first of all give you the introduction about the cash distribution method that can be taken by firm to its shareholders. So, in terms of use of free cash flows, recall that free cash flows are the cash flow left available free to be paid out to all of the firm's capital providers, including both equity providers and debt providers, as we have learned in chapter 10, right? Do you remember? So free cash flow is cash flow left available free to be paid out to the firm's capital providers after meeting all operational requirements and tax obligations. So using free cash flows, the company can pay out its capital providers. From the free cash flows, first of all, the firm has to pay interest because that's an obligation. It's not a matter of choice. If the firm is using a certain amount of debt, the payment of interest and principal, that's an obligation. So it's not a matter of choice. And from the free cash flows, the firm has to first pay interest and principals, if any amount of principals due to the company's debt holders. And then after netting out the interest payments, what's left is really what's left available for the firm's shareholders. Using this amount of cash, the company will make two layers of decisions. Okay, first of all, the primary decision is the retain versus payout decision. So basically, the company will decide whether to retain the cash flow within the company for future uses or to pay out the cash directly to shareholders in the form of payout. Okay? So if the company decides to retain the cash within the company, once again, the company will make choices between two possibilities. First of all, the company can use that retained cash to invest in new projects, or if the company doesn't have no positive NPV new projects at hand right now, it can just increase its cash reserves and balance and keep the money in the company's cash reserve. Instead, if the company decides to pay out the cash to shareholders, then the second layer of decision has to be made. In other words, the company has to decide the form of payment or the method of payment. So that in this layer of decision, the company can make a choice between the stock repurchases and cash dividend. So what we are going to focus in this chapter is the second layer of decision the firm is paying. Basically, the stock repurchases versus cash dividend choice. We are not going to consider the first layer of decision, in other words, retain versus payout decision, because that resembles the capital structure decision a lot. So know that if the company retains more cash, it means, or it is equivalent to less need of raising more debt. Okay, so theoretically, retaining more cash, that has same effect as borrowing less. So all the considerations and factors the company will put into consideration in this first layer of decision are same as the considerations and factors that affect the firm's capital structure decision. Okay, so we are not going to give full thoughts on the first layer of decision, the retain versus payout decision, but what we're going to focus in this chapter is the second layer of decision, the repurchase versus dividend choices. Okay, so know that what we are going to consider in this chapter is once the firm has decided to pay out a certain amount of cash out to its shareholders, then the question at hand that we want to address is whether the firm should do it through repurchase or cash dividend. Okay, so this decision, the second layer of decision represents firm's payout policy. So basically, payout policy means the way a firm chooses between the alternative ways to pay cash out to its shareholders. And the firm has two main choices. One is cash dividends, and the other is stock repurchases. So we are going to investigate how each method of payment works before we consider the valuation effect of payout policy. Okay. So let's start with the dividend, and let's see how dividends are paid and made. Okay. First of all, public companies' board of directors have to determine the amount and timing of the firm's dividend. So just like all other important corporate decisions, when it comes to dividend payment as well, it's the BOD that makes the decision. So the BOD will determine the amount and timing of the cash dividend. Okay, and surrounding the dividend payment, there are 4 important dates that you have to know. First of all, the most important or the first coming date is what is called declaration date. Okay, so declaration date is the date on which the board of directors authorizes the payment of the dividend. On this date, the news of cash dividend is made public, and therefore public investors become aware of this upcoming cash dividend for the first time. Okay, well, and when the company makes the declaration about the upcoming dividend, the company will announce the record date. So record date is the specific date set by a public company's board of directors such that the firm will pay a dividend to all shareholders of record on this date. So record date is the date the company goes on and take the record of all existing shareholders. So if you appear on the firm's book of shareholders as of the record date, you are going to receive the dividend that was declared on the declaration date. Well, does that mean that you can purchase, you can make the purchase decision on the record date and still receive the dividend? Actually, no. Probably regarding the dividend payment, the most important date is what is called ex-dividend date. So ex-dividend date is technically 2 business days actually, 2 business days prior to a dividend's record date. Okay, well, starting from the ex-dividend date, the company will, the stock will begin trading without the declared dividend. So ex in Greek or Latin, it means without. Okay, so starting from the ex-dividend date, if you purchase the stock, you are not going to receive the dividend that was declared on declaration date. Okay, so the ex-dividend date is a date on or after which anyone buying the stock will not be eligible for the dividend. Okay, so we are gonna do more practice on the ex-dividend date calculation in a minute. But the last 4th important date surrounding the dividend payment is the party date, which is payable date. The payable date is the date on which a firm mails dividends checks to its registered shareholders. Okay, so it's generally within a month after the record date happens. Okay, well, to understand the record date and ex-dividend date better, let's consider this example. Okay, so suppose today is the record date. So April 20th, 2020, Monday. Okay, and when would be the ex-dividend date in this case? So ex-dividend date is 2 business days prior to the record date. Okay, so let's do the counting. Yesterday, April 19th, was Sunday. So it's not a business day. The market didn't open, so it's not counted. April 18th, Saturday, for the same reason, it was not the business day and the market was not open, so it's not counted. April 17th, Friday, past week, was 1 business day prior to the record date. And April 16th of the last week, Thursday, that was 2 business days prior to the record date. Therefore, that was the ex-dividend date in this case, or in this example, okay? And in this example, when would be the last date to make the purchase decision and still receive the declared dividend? That was April, actually, sorry, there's a typo. That was, sorry, that was April 15th, Wednesday. Okay, so April 15th, Wednesday was last date to purchase shares and still receive the dividend. Because starting from the ex-dividend day, meaning without dividend, you are not going to receive the dividend when you purchase the stock. Okay, so do you understand the relationship between the record date and ex-dividend date and the last date to purchase the shares to receive the dividend? Okay, so you should be able to do this kind of calculation to undertake the final. Okay, so let's go back to our main slide. Okay, so declaration date, ex-dividend date, record date, and payable date are 4 important dates surrounding the dividend payment. Well, in the Microsoft one-time cash dividend payment example that we discussed in the beginning of the chapter, the declaration or the announcement was made on July 20th. So July 20th was the declaration date for the Microsoft one-time special dividend. Okay, on that day, the BOD of the Microsoft declared that and announced that a special dividend of $3 per share will be paid out. And in that announcement, the company said the company will go on and take the record on November 17, 2004. So November 17, 2004 was record date in this Microsoft special dividend example. Okay, and the ex-dividend date is 2 business days prior to the record date. Therefore, the Microsoft example, November 15, 2004 was ex-dividend date. Okay, starting from November 15th, buyers of stock did not receive dividend, this one-time special dividend. So if you were interested in receiving this one-time special dividend of $3 per share, then you had to make the decision no later than November 14, 2004, okay? Because that was the last day to purchase the stock and still receive the declared special dividend. And later on December 2nd, 2004, actual dividend checks were mailed out. So it was the payable date for the Microsoft special dividend example. Okay. All right. Keep going on. Well, there are 2 different kinds of dividends that can be made. First one is regular dividends, and second one is special dividends. So regular dividends are, as the name says, the dividends that regularly paid and repeat. In the US, in most cases, regular dividends are paid at the interval of a quarter. So every quarter, the regular cash dividends are made. What's very interesting about the regular dividend payment is the fact that there's a very little variation in the amount of the regular dividend from quarter to quarter. So referring to this phenomenon, people say that dividends are sticky or sticky dividends. So in other words, the amount of regular dividend payment rarely changes quarter by quarter. Okay, So we are going to discuss more about why, but for now, just know the phenomenon. The empirical phenomenon is that the regular dividend amount rarely changes quarter by quarter, okay? As opposed to that, special dividends can be any amount, and it doesn't have any regularity or it's not repeated. So it's just a one-time dividend payment a firm makes, and usually the amount of special dividend is much larger than a regular dividend. Okay, so the next chart vividly shows the pattern of the special dividend and regular dividend. So this chart shows the historical dividend for GM stocks from 1983 until 2008, basically 25 years amounting to 100 quarters. So the blue bars, ignore the light color blue bars. These are before adjusting the stock split. So just pay attention to the dark blue bars because that's after adjusting for the effect of stock splits. So the dark blue bars, they show the regular quarterly dividend amount. And the two yellow bars, they represent the two special dividends that happened during the period, okay? So what pattern can we read from this chart? What pattern do you read from the dark blue bars, which is showing the history of regular dividend of GM stock? Yes, there is a very little variation, right? As you can see, over that 100 quarters, there were only 9 times that the company changed its regular dividend amount, okay? So 1, 2, 3, 4, 5, 6, 7, 8, 9 times of changes. And if there's any change, it's more likely upward than downward. So first of all, the firms are very reluctant to change its regular dividend amount. We can read from the graph. And if there's any change, it's more likely to be a dividend increases rather than dividend cuts. Actually, over that 25-year period, there were only 3 times that company, GM, actually cut its dividend amount. The first two are surrounding the same event, okay? And actually in early 1990, the company was in bankruptcy. And second time the company cut its dividend was in 2006, which was also when the company was going through major restructuring, okay? So as we can see, the company is very reluctant to cut its dividends unless the firm is in a really bad situation. The firm is in a deep, deep financial distress, okay? So as we can see from this GM historical dividend chart, the first time the company cut its dividend was when the company actually went to bankruptcy court. And second time the company cut its dividend, the company managed to avoid the bankruptcy court, but the firm had to go through the major restructuring. So both times the company was in a really bad shape. So unless the firm is in a really big trouble, the firm is very reluctant to cut its dividends. Okay, so that's the first pattern that we read from this chart. As opposed to that, the special dividends represented by the two yellow bars, they are not repeatedly happening, but they are just happening randomly. And the amount is normally much larger than the regular dividend amount, okay? So the GM stocks dividend history very vividly characterizes the pattern surrounding the regular dividend and the special dividend. Well, whether it being regular or special, the accounting implications is the same, okay? So what are the accounting implications of dividend payment? So from the firm's part, cash dividend payment, that's cash outflows from the firm. So it's going to reduce the firm's current cash balance and also its current retained earnings. So let me show you the implications using this balance sheet chart. Okay, so this is the standard balance sheet for the company. So as you know, on the balance sheet, we have assets on the left-hand side and liabilities and equity on the right-hand side. assets on the left-hand side and liabilities and equity on the right-hand side. Within the assets, we have current assets and long-term assets, which is PP&E. And within the current assets, we also have cash and cash equivalents, inventories, and account receivables. On the right-hand side, under the liabilities, we have trading debt like account, sorry, that's a typo, like account payable. And also we have capital debt like long-term debt, okay? And also on the right-hand side, we have stockholders' equity. And within the stockholders' equity, we have two categories as well. The first one is paid-in capital, and second one is retained earnings. So you can think of the paid-in capital as externally raised equity, and retained earning, internally generated equity, okay? So as we learned in chapter 14, whenever the company receives, raises external equity from venture capital or angel investors or from IPO, the paid-in capital amount will increase. As opposed to that, if the company retains some of its operating generated cash within the company, that goes to the retained earnings, okay? And what are the impacts of dividend payment? To pay dividends, cash dividends to its shareholders, the company has to incur the cash standing. So the cash and cash equivalents account on the left-hand side will decrease. The cash is leaving the company, right? And to make the balance sheet balance out, something on the right-hand side should decrease as well. What would that be? Yes. The matching account on the right-hand side is the retained earnings. Because remember from the very first diagram that we had seen on this chapter, free cash flow chart, after the company pays that interest payment from the free cash flows, the company will make the retain versus payout decision, okay? So if the company pays out more of dividend, the cash balance will decrease, and that will mean less cash left to be retained. Therefore, the retained earning will decrease. Okay, so know that whether it being regular dividend or special dividend, the accounting implication of the dividend payment is cash decrease as well as retained earnings decrease. Okay, so now let's go back to our original main slide. Okay, so the accounting implication of the dividend is cash balance decrease and retained earnings account decrease. So that is dividend payment. And now let's see how share repurchases are made, okay? Well, if the company chooses stock repurchases as a method of payment to shareholders, the company will use its cash to buy back its own shares instead of paying cash directly to its shareholders, okay? And then the repurchased shares are held in the corporate treasury and can be resold if the company needs to raise money in the future. Well, but if that's confusing, just you can think of the repurchased stock will be distinguished, okay? So after the company repurchases stock, they will be no longer traded in the outside market. So the number of shares outstanding will be decreased after the stock repurchase, okay? There are three possible transaction types for a share repurchase. Number one is open market repurchase. Number two is tender offer. Number three is targeted repurchase. But when it comes to stock repurchase made in the context of the payout, it always happens through the open market repurchase. Okay, the tender offer and targeted repurchase, they do not happen in the context of the payout. They happen in the context of the takeovers or mergers and acquisitions. Okay, so know that stock repurchase that we are discussing in this chapter will be happening through the open market repurchase. Okay, so how does the open market repurchase work? Open market repurchase is the most common way of a stock repurchase, representing 95% of all repurchase transactions. Okay, so if the company does open market repurchases, the company will announce its intention to buy its own shares on the open market, and then proceeds to do so over time, similar to any other investors. So when the firm does open market repurchases, it will buy back its own shares as if all other regular buyers would do in a regular open market. Okay. So it may take a year or more. Normally, open market repurchases takes long time. Could be taking easily a year or sometimes 3 years or 5 years. Remember in the Microsoft example that we discussed in the beginning of the chapter as well, the Microsoft announced its plans to use up to $30 billion over the next 3 to 5 years coming. Okay, so normally it takes long time. Okay, and the firm announces its intention to use up to a certain amount, but the firm is not obligated to repurchase the full amount announced. Okay, so the company has way more flexibility when it comes to open market repurchases compared to the cash dividend. Okay, one thing that a firm has to be aware of when it performs open market repurchases is that it must not buy shares in a way that might appear like manipulation, because the SEC will be closely monitoring you, and if the transactions somehow look like some manipulations of stock prices, then you will be caught. Okay, so normally the company will avoid the first and last 30 minutes of the daily market. So the first 30 minutes when the market opens and the last 30 minutes before the market closes. And the company will only buy a small fraction of daily trading volume, not exceeding 5% of daily trading volume. Okay, so when the firm chooses open market repurchases to do its share repurchases, the company has to be careful not to make it look like a manipulation. Okay. Well, so as we discussed, open market repurchases are often used when a firm wishes to repurchase a substantial portion of its shares, often as part of a recapitalization or as a part of payout. Well, as I said before, tender offer and targeted repurchases do not happen in the context of the payout policy, but let me just go over it briefly, how it works. So tender offer is used when a certain investor is interested in taking over a company. So tender offer is a public announcement of an offer to all existing shareholders to buy back a specified amount at a pre-specified price over a short period of time, normally within 20 days. So suppose you are an investor who wants to take over a company, and suppose you want to buy up to 20% of the firm's shares, okay? And your goal is to garner about 20% of the firm's shares, and you want to achieve that within the next 20 days. And you will make a take or leave offer on the table. And normally you will give a premium price, so any interested investor can offer their shares. So the price is usually set at a substantial premium, like 10 to 20% of current stock price. And the offer often depends on shareholders tendering a sufficient amount of shares. If not, so for example, if you did not achieve to acquire 20% of shares that you wanted, then the firm may cancel, the investor may cancel the offer and no buyback offers. Third kind of share repurchases, which is targeted repurchases, they can normally used as a defense to the hostile takeover. So a firm repurchases shares directly from a specific shareholders at a negotiated price. Okay, a targeted repurchase may occur if, first of all, a major shareholder desires to sell a large amount of shares, but the market is not sufficiently liquid to sustain such a large scale of sale without severely affecting the price. So in this case, repurchases will often made at a discount price. Second of all, a target repurchase can happen if a firm decides to eliminate a major shareholder's threat to take over the company by buying out the shareholder, often at a large premium. So this is when the targeted purchase is used as a defense to hostile takeover. But once again, targeted repurchases and tender offer do not happen in the context of the payout, but the stock repurchase that we are discussing in this chapter is always the open market repurchases. Okay, so that will conclude today's lecture. And starting from next week, we are going to investigate the relationship between the firm's payout policy and the firm's value. Okay, so this is it for today.